The only way to save trade for the UK is by leaving the single market. That's what Leave campaigners claimed during the 2016 referendum. Back then, the country was split into two: those who believed the EU membership would save UK trade, and those who believed that it would inevitably destroy it. Let's fast forward to 2023 for a moment, when the European Centre for International Political Economy, the ECIPE, released its report titled "The Critical Importance of the Single Market for Europe's Global Trade Performance." Here's a graph that showcases said political importance. Here, we can see that the single market has created €1 trillion of intra-EU trade in goods among the EU members between 2012 and 2021. At the same time, extra-EU trade expanded by only €0.4 trillion. Bear in mind, this was at the time of the COVID-19 pandemic when the world had effectively shut down. 27 member states reaped the benefits of being a part of the single market. Free movement of goods, services, capital, and people across member states, eliminating barriers like tariffs and regulations. It fosters economic integration, enabling businesses to trade seamlessly and individuals to work, study, and live across the EU. One former member state watched from the sideline: the United Kingdom. Today, we're unraveling Brexit's economic impact and answering the question, why trade isn't what it used to be. To better understand Brexit's economic impact, we've divided this section into several parts: before the referendum was held, once Brexit became a reality, and where the United Kingdom stands in trade in 2024. That is, 4 years after the fact. To start off, let's rewind to 2015 when Euroscepticism might have been at an all-time high and David Cameron had announced plans to hold a referendum. But Brexit wasn't a concrete reality just yet. The purpose here is to present facts, even the cold, hard, and undigestible ones. Many people who oppose Brexit would claim that the UK's economy was doing tremendously well in 2015. It was not. Suffice it to say that the United Kingdom was struggling with an almost $34.8 billion trade deficit between imports and exports. According to the ONS, the trade deficit in 2015 was the highest recorded over the past 4 years. This came as a shock for the Conservative Party, who were banking on their stellar economic record. Apparently not. Take a look at this graph prepared by the World Integrated Trade Solution. We're looking at the valuation of the United Kingdom's exports and imports over several years, but of particular interest here are 2008, 2013, and 2015. The recession in 2008 set the UK back, but the economy managed to bounce back by 2013, only, however, to dip again in 2015. Quarter-end reports released by the ONS in December 2014 showed there had been a surge in oil imports, ending the year on a weak note for trade. Good exports saw minimal growth. Imports rose significantly, and the trade deficit shot up in the final quarter. The gap widened from £9.3 billion in November to £10.2 billion in December. The results were disparaging, according to economists, who believe that they'd close the year strong with a deficit of £9.1 billion. Not the best, sure, but not the worst either. What drove the increase? In a word, oil. There was a £0.9 billion increase in imports, £0.7 billion of which could be attributed to fuel imports from Norway. Previously, oil imports reached their highest level in July 2008, rising by 37.5% between November and December, according to the Office for National Statistics. Looking ahead into 2015, economists predicted continued pressure on exports due to a strong pound and slower growth in key markets, particularly the Eurozone and China. Speaking of the Eurozone, many economists believe that the trade deficit was because of the Eurozone. As the UK's largest trading partner, the Eurozone accounted for over 40% of its exports back in 2015. Sluggish economic growth, coupled with deflationary pressures and high unemployment in key markets such as Germany, France, and Italy, reduced demand for British goods and services. The euro's depreciation against the British pound intensified the issue. A stronger pound made UK exports more expensive and less competitive in Eurozone markets while making euro-denominated imports cheaper. This exchange rate dynamic discouraged Eurozone countries from importing British goods while increasing the UK's reliance on cheaper European imports in 2015. Despite some improvements in export volumes in late 2015, the trade imbalance persisted due to continued weak Eurozone growth and external pressures, including the slowdown in global markets like China. These factors underlined the UK's vulnerability to regional economic trends and exchange rate shifts. The UK government sought to address trade challenges by promoting exports and encouraging investment in high-growth markets outside the EU, such as India and Southeast Asia. Initiatives included trade missions and export financing schemes aimed at helping businesses expand globally. However, structural issues, such as low productivity and reliance on imports, remained as key obstacles to achieving a more balanced trade profile. Now, let's talk about the link between trade and Euroscepticism. Take a look at this graph released by the Office for National Statistics. It illustrates the goods balance, services balance, and total trade of the UK from December 2013 to December 2015, with data divided into quarterly reports. The graph reveals an immediate dip in late 2013, followed by fluctuations and a largely downward trend throughout 2014 and 2015. Notably, there was a brief period in the third quarter of 2015 when economists expressed cautious optimism for improvement. However, by the end of 2015, the UK concluded the year with a substantial trade deficit. This persistent trade imbalance raised questions and concerns that ultimately fed into the Brexit debate. Could poor trade performance have fueled the push to leave the European Union? At the time, the United Kingdom's trade challenges became a central argument for Eurosceptics. Critics pointed to the widening trade deficit as a consequence of the country's EU membership. They argued that, as one of the EU's largest economies, the UK was expected to engage primarily in intra-EU trade. While this wasn't a formal rule, the EU's policies, such as reduced tariffs, minimal customs barriers, and streamlined trade regulations, made intra-EU trade more attractive. This environment encouraged economic integration within the bloc, even as the UK continued to trade globally with partners like Canada through EU-negotiated agreements. Eurosceptics, however, contended that the EU's sluggish economic growth and structural issues, including high unemployment and deflation in key member states like France, Italy, and Greece, hurt the UK's trade prospects. They claimed that weak demand for British exports from the Eurozone, paired with the UK's increasing reliance on cheaper EU imports, exacerbated the trade deficit. To them, this highlighted the EU's failure to act as a reliable and beneficial trading partner, undermining the supposed advantages of membership in the single market. The United Kingdom wanted a Canada-style trade agreement with the EU, but what does Canada-style trade with the European Union look like? To better understand this, let's take a look at this graph released by the European Council in 2022. This chart compares trade in goods and services between 2016 and 2022, showing growths for both goods and services. Goods increased from 46.32 billion euros to 77.04 billion euros. Services increased from 25.62 billion euros to 41.43 billion euros. Likewise, data released by the Jean Monnet Network on transatlantic trade politics showed that the trade between Canada and the EU has seen exponential growth since CETA was implemented. Despite economic challenges due to the COVID-19 pandemic, trade relations between Canada and the EU continued strongly. The trade between Canada and the EU still grew to a record high of $100 billion in 2021, a 33.7% increase compared to the 18.6% growth in 2016 that was recorded by overall Canadian merchandise trade over the same period. Unsurprisingly, the UK wanted the same deal. Once the results of the June 2016 referendum were read, the Conservative Party began implementing steps almost immediately to make Brexit into a reality. The political chain of events started with David Cameron's resignation, who'd been an advocate of the Remain group. Yes, despite calling for a referendum, Cameron was in support of staying in the EU, albeit he admitted that there needed to be changes in the UK's relationship with the Union. Theresa May stepped into office only to step out after no trade agreement was signed with the EU. Technically, the UK didn't need the EU to sign off on a trade agreement to be able to leave the Union. However, after decades of having the Eurozone as their primary trading partner and reaping the benefits of the single market, everyone knew that it'd be in the best interest of the UK to contract a deal with the EU. Yet, Boris Johnson threatened to walk out of the negotiation room, enact a no-deal Brexit, and wash the UK's hands completely clean of the Union. That is, if the UK didn't get the same deal that Canada did. We want a comprehensive free trade agreement, similar to Canada's. Trade between Canada and the EU is modest compared to the UK-EU relationship. In 2018, the UK exported £291 billion worth of goods and services to the EU, 45% of all UK exports, and imported £357 billion, that is 53% of all UK imports. In contrast, Canada's trade with the EU accounted for a much smaller share of its total imports and exports. The UK eventually got a trade deal of its own, the EU-UK Trade and Cooperation Agreement. Very briefly, these are the main constituents of the agreement. The TCA eliminates tariffs and quotas on goods traded between the UK and the European Union if they meet the rules of origin requirements. What are those requirements? These are the strict rules that define where goods are produced to qualify for tariff-free trade, encouraging goods to originate primarily in the UK or EU. The difference here between the TCA and being a member nation, thereby being a part of the single market, is that while tariffs are avoided, custom declarations, regulatory checks, and other non-tariff barriers apply. Likewise, trading services have also become a little bit more complicated than they were before 2020. The TCA offers limited provisions for UK service providers, particularly in financial services, which no longer have passporting rights in the EU. Mutual recognition of professional qualifications is not automatic and requires further agreements between regulatory bodies. Of particular importance here is the clause that deals with fisheries. The TCA includes a transition period of shared fishing rights, reducing EU access to UK waters gradually over 5 years. Post-transition, fishing rights will be negotiated annually. The TCA includes mechanisms for periodic review, renegotiation, or suspension of specific provisions. A formal mechanism allows for resolution of disputes, including retaliatory measures like tariffs if one party violates the agreement. Both the UK and EU can terminate or revise parts of the agreement. These were just a few of the misconceptions propagated by the Leave group at the time of the 2016 referendum that eventually led to Brexit. However, for today's video, we're taking a look at another popular misconception that was championed by those who wanted the British public to vote Leave. The EU will become the UK's biggest customer. Let's divulge this. Firstly, why did the Leave group believe that the EU would become the UK's biggest customer? In all fairness, the statement was based on several facts, and it wasn't necessarily a far-fetched thought either. The EU was, after all, one of the United Kingdom's biggest trading partners. By virtue of its position in the Union, the UK would primarily trade in the single market because of the reduced tariffs, customs, and quotas, close to none. However, that also meant that other members of the Union could reap the same benefits. While the UK was making money through trade with member nations, it was making less than what it could have had it treated the Union as a regular customer. The difference would have been offset by the higher price that the UK itself would have had to pay. But still, the UK could treat the EU as its customer, and that would boost trade more than being a member state. Now, several years after the fact, did that actually happen? The former Minister for Brexit Opportunities and Government Efficiency of the United Kingdom, Jacob Rees-Mogg, made a startling declaration in 2016. We have a deficit with the rest of the European Union of between 80 and 100 billion pounds a year. We are the major customer for the European Union of any country in the world. Whilst we're still in the EU, the biggest customer is the US. Once we're out, it'll be us. Let's dissect his statement and why Rees-Mogg believed it to be true at the time versus, of course, is it true? The UK imported 80 to 100 billion pounds more from the EU than it exports annually, according to EU data at the time of the referendum. In 2015, the UK had a goods trade deficit of 109 billion pounds with the EU, but a 17 billion pound surplus in services, resulting in an overall trade deficit of 92 billion pounds. UK figures, which differ slightly due to data collection methods, estimate a 21 billion pound services surplus and an 89 billion pound goods deficit, putting the overall trade deficit at 68 billion pounds. Despite these discrepancies, both sources highlight the UK's growing trade surplus in services and its widening deficit in goods. The EU data also shows the UK as the EU's largest customer, with more EU exports going to the UK than any other country. If the UK leaves the EU, it would still be the EU's biggest external export market, assuming trade levels remain steady, underlining the mutual importance of securing a trade deal. According to the Consequences of Brexit for UK Trade and Living Standards, released by the Centre of Economic Performance, EU trade agreements over 2 decades reduced UK trade imports by over 1/3, benefiting UK consumers significantly more than any other long-standing EU members. Leaving the EU meant losing benefits from agreements such as the Transatlantic Trade and Investment Partnership with the US and a partnership with Japan. These deals were estimated to lower prices by 0.4% and 0.2% respectively. Interestingly, the US has expressed reluctance to pursue a trade deal with the UK alone, further complicating post-Brexit trade prospects. This might be a great time to point out another misconception at the time of Brexit. One suggested that leaving the EU would allow the UK to create a better trade deal with the United States. No such deal has been finalized so far. The Eurozone has been a cornerstone of UK trade, serving as a stable and expensive market for British goods and services. Before Brexit, it accounted for over 40% of UK exports and more than 50% of imports. Through the single market and customs union, the EU enabled seamless trade with Eurozone countries, eliminating tariffs and reducing non-tariff barriers that conventional trade agreements couldn't achieve. Financial services, legal expertise, and consultancy were key exports, with London serving as a global financial hub. In 2015, the UK achieved a £24 billion services trade surplus with the EU. Likewise, UK car manufacturers depended on importing components from Germany and other Eurozone nations, assembling vehicles domestically and exporting them back to EU markets. Additionally, the Eurozone's economic scale, with over 300 million consumers, offered UK businesses significant growth opportunities. Small and medium-sized enterprises particularly benefited from access to this vast market, which helped them achieve economies of scale. Everything changed when Brexit happened. So, here's where we're at. Several years after the UK left the EU. Yes, in the years leading up to the referendum, there had been concerns, valid ones at that, about the UK's trade within the Eurozone, and how membership in the Union had limited trade. This was compounded by the fact that the UK's trade performance, particularly in 2014 and 2015 when the referendum had become an undoubted reality, was faltering. That being said, when the UK decided to move forward with Brexit, it had grossly overstated the changes in trade to the British public. For one, the Canada-style trade agreement that they wanted was, in fact, the Trade and Cooperation Agreement. This was not the same as being in the single market, and how could it have been? The UK believed that it could leverage its position as one of the strongest economies in Europe and become the EU's largest trading partner, treating it more as a consumer than as a partner. That didn't happen. Ultimately, do you think the UK kicked a gift horse in the mouth, or was it justified to go forward with leaving the European Union?